All right. Thank you everyone for joining the inaugural Frax Town Square. Super excited to get this going. Here we'll be discussing the latest governance proposals in the Frax Forum. It's been quite lively lately. Discussions ranging about AMOs to gauges to potential, loans and token swaps. Really exciting to see. And yeah, we'll just get this going. How this is going to work is we have four proposals here. We have one from Centrifuge, one from dAMM, one from Commonwealth, and another from Beanstalk. We're going to give them 10 to 15 minutes to make their case, and then another 5 minutes for the audience to ask questions. So without further ado, we'll get this started, and I'll have Mike from Centrifuge on first. So Mike, feel free to unmute, introduce yourself to everyone.
Yeah, hey guys. Thanks for having me on. Happy to be here. Happy to be part of this new series around Frax governance. And yeah, as Dave said, really excited about what's been going on, in the Frax community in general, and with all these interesting and hopefully ultimately successful proposals that are looking to grow the Frax asset base and Frax footprint within the ecosystem. I guess I will give a kind of highlight of what we're proposing, maybe touch on some of the points that I find interesting within the discussion. Obviously, market backdrop's moving super quickly, which keeps this lively and interesting, and how we can think about being creative and dynamic, and best responding, both for the safety and kind of growth potential of Frax at the same time. But I guess to kick into the proposal, I think I'll give a couple minutes on Centrifuge just in case anybody's not familiar with the protocol, and then I will jump into what we're proposing to Frax. But Centrifuge was actually I think the first DeFi protocol to look at the interface of real world assets, i.e., off chain assets, and DeFi. And our kind of thesis was to bridge real world assets into DeFi, allowing them to have a tokenized representation of themselves, and then create liquidity pools that DeFi investors can use to gain exposure to said real world assets. Kind of the overarching point there, which I think is very interesting for stablecoin providers like Frax and DeFi in general, is we were, the first to kind of start hypothesizing about how to break the link of a closed loop crypto ecosystem, if you will, and bring in productive yield bearing assets from the real world, that kind of touch everyday people, whether it's business lending and real estate and kind of consumer finance, invoice finance, actually lending to businesses that are on the street today. And I think that's really important for where we go from here as an ecosystem altogether. I think, DeFi generating yields within a closed loop is great when everything's going up, but I think as we can see when things move down, you kind of get quite a negative or quick or sharp unwinding of some of those token generated returns that don't necessarily create productive work on the back end. So Centrifuge today, we launched on L1 Ethereum almost 2 years ago. We've grown to 12 live pools, touching pretty disparate asset classes. So we're asset class agnostic. We have a pool that focuses on real estate lending. We have invoice lending, trade finance, consumer finance, microfinance, and a few other things in between, SaaS-based revenue financing. So quite a broad base of asset-backed lending. Our pools are fully collateralized. So within the pools, you have a digital representation of the obligation off-chain, which you can actually seize through legal recourse. And your investments there are fully collateralized investments, and they generate yields, generally in the low single digits to kind of mid low teens. I think we've grown from 20 million last year, and now we financed over 125 million in net lending. We were the first DeFi protocol to integrate real world assets with MakerDAO, as well with Aave. So we really have been, a pioneer in the space of trying to bring real world assets to the the DeFi ecosystem, and now following that up with Frax. And that leads into our proposal in the Frax governance forum, and we really want to bring some of what we've done with MakerDAO, which we think can really, not only help a stablecoin grow and actually proliferate into real world lending cases, which is kind of my end game vision for how stablecoins can properly scale and truly scale, but also to diversify the asset and collateral base by bringing crypto uncorrelated assets to Frax's asset side of the balance sheet. This should help, in times of destability, when everything's kind of beta one and moving in lockstep. You get a kind of diversified effect in your balance sheet, which should, in theory, kind of increase confidence in the peg, and also not have forced liquidations in the case like with Maker, like we're seeing when ETH prices move sharply. Liquidations occur at a pretty rapid pace. So I think that's the proposal we want. We initially suggested 100 million AMO, where we could investigate a bunch of different ways to deploy Frax capital into Centrifuge pools, whether that be a custom vault to Frax's liking, focusing on shorter duration assets, longer duration assets. I think those are all to kind of be hashed out in the days and weeks to come. But the basis of the proposal is really that Frax lends, an amount of money to Centrifuge, probably scales through from like a 10 million and hopefully get up to that 100 million over several months, if not longer, as market conditions allow, and it's safe for Frax to be able to do that. And that's where the proposal is today. I think the discussion within the forum has been quite lively. People, now really weighing up the benefits and the kind of cons of real world assets, and the kind of the illiquidity premium that you're paying for essentially what I view as stability and growth, and trying to find the right balance in those variables. And I think, I encourage anybody who hasn't seen the proposal to jump in the forum, check it out, give your opinions. I think it's still very nascent in this wave of DeFi, and it's helpful to have contributors that know about the subject. I think there's been a great amount of knowledge. Very impressed thus far within the Frax community, and excited to see where this goes. And I will leave it for questions.
Great. Yeah, if anybody has any questions, feel free to raise your hand and I'll invite you up.
Mike, I got a question to start off with. Maybe you can talk about some of the risks that are involved with this, and also some of the opportunities for Frax. I know you touched on them, but maybe you could come back and talk about them again.
Yeah, for sure. I think these are probably the most important factors to weigh up in this current situation where we're at. I guess first, to touch on the opportunities. I think real world assets is a very broad term. It's kind of a loose term, but what are we actually offering here? We're offering credit opportunities. So these are cash flow generating credit opportunities, and really the sea of collateral, if you will, in the real world for these kind of opportunities is very vast. And for a stablecoin issuer like Frax, that has a extremely low cost of capital, they don't have branches and bankers and all this stuff. Really, kind of the holy grail in my view is competing with the traditional financial system and being able to lend, not only to crypto traders and speculators who want leverage within the crypto ecosystem, or a store of value within the crypto ecosystem, but also to real world, to businesses. And it doesn't only need to be real world businesses. It could also be to other protocols, to crypto market makers. We've seen that use case be quite successful. But for us, we're really focused on this vast sea of real world asset collateral. So I think that's the big growth opportunity I see for Frax. Really is being able to lend against these opportunities. It scales the circulation or demand for Frax, while also generating yields for the treasury at quite attractive rates, in my view. And yeah, I think there's like the near term of generating yield and diversifying the asset base, and then like the longer term vision of actually kind of getting stable coins just out of the crypto kind of closed loop. I think on the risk side, to be clear, I think the biggest risk is liquidity. Whenever you take on a term loan, and that could be, you know, within the digital sphere to a market maker or a protocol, or in the real world, you take some kind of duration risk. So if they're short duration assets, it could be 3 months, 6 months, and if they're longer duration assets, it could be a year, 2 years, 10 years. Obviously, I would suggest definitely in the experimentation in the early days to focus on shorter duration assets in case there is a liquidity crunch in the market where there's a lot of redeemers and you can't mobilize or kind of deploy your balance sheet to kind of protect the protocol. So that would be my suggestion, but those are kind of the two big risk reward trade-offs I'm seeing today.
Thanks for that explanation. Does anybody else have any questions? Nope, don't see anything. Could you share like where people can learn more about Centrifuge and also yourself?
Yeah, for sure. You can check out Centrifuge.io, which is our kind of main landing page for the protocol. Obviously, our Twitter, Discord's pretty lively as well. You'll find the links on Centrifuge.io. Also, add me up on Twitter. You know, trying to get more active at the Space Cat Junior. I'll drop it. I'm sure you guys can see my handle here actually. And also follow the Centrifuge Twitter account for updates.
Sweet. Thanks, Mike. And
thank you for having me.
Of course. And excited to see where the proposal goes.
Me too. Thanks, guys. See you.
And next we have Joshua from dAMM Finance. Joshua, how are you doing today?
Wonderful. Yourself?
I'm doing pretty good. Yeah, so could you give a little bit of an introduction about yourself and what dAMM is and what you are proposing to Frax?
Yeah, absolutely. So I guess a little bit of background about myself and dAMM. So I started in private equity out of college and then started working. I started the market making firm System 9 with Peter Sokolow, our CEO. Currently, we're one of the, I'd say, top 5 altcoin market makers in crypto. We make markets we're the dedicated market maker for more than 80 tokens. We're making markets on more than 150 pairs on 30 exchanges. We've done tens of billions of dollars in volume, and dAMM is the first protocol that we're spinning out and incubating as a market maker. So as a primarily altcoin market maker, it's unbelievably difficult to borrow altcoins. So you usually see governance proposals like the Wintermute and GSR proposals for ohm and whatnot to borrow directly. So dAMM is kind of a way to automate all of that, and where token issuers, DAO treasuries can get access to lend directly to market makers that are going to provide market neutral market making in their token. So we're backed by Kronos Research, ourselves at System 9, AscendX, Gate.io, and Gate Ventures, and we have about 5 or 6 of the largest market makers in crypto backing and borrowing from us. We'll be making some announcements about names and things like that soon. And so these are market makers that we vetted thoroughly that are going to be making market neutral markets across all the exchanges, decentralized and centralized, that a token is trading on. Frax got us incredibly interested. We've been following and making markets in Frax for about 6 months now as a firm. So primarily why we want to work directly with Frax over using another stablecoin on an under-collateralized lending platform. Guys like Maple, TrueFi, they're currently the biggest lenders to market makers from DeFi. They all use USDC only. We wanted to implement a decentralized stablecoin that could grow with us. And so Frax is, like the definition of that. And Frax as the backbone of our protocol just makes the most sense, especially with the AMO procedure and the ability to, mint new tokens and work directly and grow alongside a protocol like you guys have done with Curve. So now Frax will be able to be lent directly to market makers and used as their primary stablecoin, as well as with the exchanges that we trade with and work on. AscendX, Gate, we're currently a large percentage of trading volume on, a lot of the top 20 exchanges, and we want to work directly with those exchanges as well to list Frax as a base pair. So that's another, bonus I think for Frax as a whole, as well as for us, and gives a ton of demand for Frax. And we expect Frax to be lent out at pretty close to market rates. So under collateralized market rates for stablecoins generally are between 7 and on the high end 12%, depending on the platform. So Frax itself, that's what we expect it to be lent at, as well as we want to create use cases for all 4 of the Frax tokens. So we plan on listing all 4, regardless of our proposal, but hoping that goes through. I guess that's why we're here today, and very excited about that. We have about $5 to $10 million in tokens right now from other DeFi protocol treasuries already allocated. These are a lot of DeFi protocols that I imagine Frax users are very, very familiar with. And so we'll be announcing a lot of those in the coming weeks as our protocol goes live at the end of June and early July. And I guess the final note, kind of the cherry on top, I guess, for Frax is for all those DAOs and treasuries that we work with, we're going to do a retroactive airdrop just for the DAOs and DAO treasuries. So by working with us with this AMO, Frax will get access to dAMM and the actual governance token of the protocol. We're very excited about that. So yeah, that's kind of the high level. We know we're doing a smaller AMO. It's a $10 million AMO, but it's one we plan on growing into, and we really want to grow with you guys. And hopefully in the next 3-6 months, as the AMO begins to pay itself back, we can continue to create additional AMOs alongside. So yeah, I guess that's kind of the high level. I can get into risk mitigation as well if you guys would like. I don't know if you guys have any questions, but yeah.
Please get into risk mitigation. I'm sure people will want to hear that.
Yeah, absolutely. So, being a major market maker that, we borrow from, all the major institutional lenders, guys like, Genesis, Anchorage, all them, we're very intimately aware with the lending protocols and procedures across a lot of these, major institutional lenders. As you guys are probably seeing with Celsius, it seems they're a little bit lax with their lending standards. So we've taken it in significantly. A lot of lenders, what they'll do is they'll say, and this is a little bit of inside baseball, I suppose, but a lot of lenders will typically, they sign a master loan agreement, which is what we do, and then they lend to you a percentage of your balance sheet. Typically for most institutional lenders, and this is how under collateralized lending works, they'll typically do anywhere between 50 and up to 75% of your balance sheet, depending on the firm. We're starting off with all of our market makers significantly lower. So typically a max of 20 to 25% of their balance sheet, we're lending to them in alts. We want to be incredibly conservative with them and allow market makers to build on-chain credit history over time. So that's kind of the high level of how we plan on mitigating risk. And we're only onboarding borrowers from major jurisdictions to start with. So the 3 that we're really targeting are the European Union, the US, and Singapore. So those are the 3 we're primarily starting with. I think we're going to add Hong Kong possibly as well. But yeah, that would be the 4th. So yeah, that's how we're mitigating risk. We have a credit risk team. We're onboarding a number of people from Citibank and a couple other large credit lenders and TradFi to continue to improve our risk protocols internally. So yeah, that's kind of the high level. Yeah, thanks. Let me know if anybody has any questions.
Yeah, anybody from the audience, if they have questions, please raise your hand and I'll get you on here.
It's really interesting about the market making for Frax itself. I know that Frax as a decentralized protocol doesn't have like an official market maker, so I think that would be a big benefit for Frax itself.
Yeah, absolutely. I guess that's a really good point to bring up too. Is a lot of protocols won't use market makers because if you read the ohm proposals, for example, I mean, usually you have to fork up a huge percentage of your token supply in a call option and a loan that the market maker gets to exercise at will. As a firm, we don't take call options with our issuers ever. And so that's kind of a big motivation for us here because we want to give power back to the users and back to the token issuers. So yeah.
Question, I guess, what is your growth strategy immediately and where do you see you guys in like 2 to 3 years?
Yeah, that's a great question again. So growth strategy to start with is, as I mentioned, there's a lot of, major U.S. equities market makers that are in crypto. There's kind of only a handful of them, so you can probably back out who they are that are working with us and backing us. So their name brand, as well as the name brand of a lot of the protocols that we're onboarding, we plan on co-marketing with all of them. And we kind of have a lot of tweets and announcements that are going to be coming out in the next week or two, and governance proposals with founder backing from a lot of large DeFi protocols and DAOs. So that's really our go-to-market strategy. We want to partner directly with issuers, and I think that's going to give us a huge edge over other lending protocols. And then in the next 2 to 3 years, I really, having worked directly with a lot of these institutional lenders, I think it's a market incredibly ripe for disruption. So the goal of dAMM is to become the first both institutional and retail lending protocol and institutional lending platform. So we want to onboard clients from that use Maple and TrueFi, as well as that the high net worth individuals, hedge funds, and family offices that lend to Genesis and Anchorage. And I think by being the first protocol that does both of those, I think we want to make a beeline for being the highest TVL protocol in crypto over the next 3 to 5 years. That's really our long-term goal. I know it's a bit ambitious, but we're incredibly
not at
bullish on the
all.
space. Oh yeah.
No, I mean, like, no, you should be as ambitious as you want. And so, and one last question. It's dAMM, it's not DAM, or is it either or?
The pun is that you can say both. So if you're mad at us or something, you can say damn, but we always just say dAMM to be polite. And then towards the end of the call, it turns into damn.
Damn. Damn's just easier.
Every good protocol name has to be like a little bit memeable,
Yeah, of course. Yeah, well, I don't think there's any more questions. Let me do one more scroll to see if there's anything. Joshua, thank you so much. I'm super excited for dAMM, and definitely would love to see you guys.
Absolutely.
More.
Thank you so much. Yeah, thanks everybody. Bye.
See ya. And next up, we have George from Commonwealth. George, how are you doing today?
Good. How are you doing?
Doing pretty well. Yeah, let's get this going. So, can you give a little bit of an introduction to yourself, of Commonwealth, and what your proposal to Frax is?
Yeah. So, I first met the Frax guys back at Everpedia. So we all worked together.
Dave,
Sam, Travis. So it's fun to see how it's a small space, and everyone will work together. Over there.
Who would have thought?
Yeah.
We'd all be in Twitter space like this, but here we are.
But yeah. Anyways, so for Commonwealth. So Commonwealth is an end-to-end DAO tooling platform. So we support, like DYDX, Osmosis, Redacted Cartel, Element Finance, a number of others. Generally, I'd say, sort of the way to think about it is, right now, especially, today, we're seeing the importance of, really being able to own your own platform and your own community. And so we enable, community-owned community platforms. So Frax would be able to have a fully crypto-native discussion forum that's backed up on IPFS. You don't have to worry about anything going down. From there, we also build out a range of voting dashboards, including a full integration with Snapshot, and have a number of other crypto-native features on the roadmap, including crowdfunding coming up soon, which we anticipate will, be really good for funding sub DAOs or sub projects. So, maybe there's even a Flywheel podcast crowdfund, and, the community can help back it, if they like the content. So, from there, we also just announced our token. Can't go into too many specifics there, but, connect the dots. Yeah, I'd say that's the main part. In terms of our proposal for Frax, we'd love to have you guys move over. It's very simple. We already have a space set up for you guys. You can export your Discourse forum. We can maintain all of the content from Discourse, upload it onto Commonwealth, change the custom domain, link with your guys' site, and you'll be back up and running, in a matter of minutes. So that's the presentation. But yeah, would love to hear any questions you guys have. Yeah.
Yeah, so could you actually go into more of the crowdfunding aspect you're hosting on there? Because actually, it's funny you mentioned that. We actually just posted a grant proposal to Snapshot for Flywheel Media. So for, if anybody who's a Frax holder who sees, who likes what we're doing here in the space, who likes our new podcast, please vote yes for that. Small plug. But yeah, but can you go into like a little bit of the details of like how it works on Commonwealth, how it's different, and yeah.
Yeah. So, pretty much right now, the major crowdfunding platforms in crypto are Mir, Juicebox, and Gitcoin. So pretty much we take some of what they all do well, and then also add on some improvements. So for instance, much cleaner UI, much easier to do discovery. If you guys have never used Mir before, you literally can't search for a crowdfund or explore crowdfunds on their site. You have to find the exact link. On Juicebox, content for each of the different projects is pretty poor, and it's pretty rigid with the kinds of crowdfunding you can do, what rewards you can offer, how it all works. So we'll have a much more flexible system in terms of, you can raise for NFTs, for tokens. You can do it in more of a public goods kind of funding similar to Gitcoin. And then additionally, we offer, or we're using dominant assurance contracts. And so what that looks like is, so say Dave is looking to raise some money for Flywheel, and he's like, hey, I want to raise like 1,000 Frax by, July 4th. And then I can say, you know what, like, I think he's going to do it. I can stake, say, 2 Frax, saying that he will. Dave is able to allocate a certain portion to people that like endorse his project. So he can say, I'm willing to give 5% to anyone who endorses me. Say I'm the only one who endorses. He hits his 1,000 Frax goal. I would end up getting 50 Frax as a reward for endorsing him. But say he only raises 500. Well, then everyone in that 500 will get their money back. Plus, they'll also get a share of my 2 Frax, which I guess, in this scenario, it's not a great return. But pretty much like why this is important is we see in research twice as many successful crowdfunds as well as twice as much money raised in crowdfunds. Because on one hand, you're giving positive incentives to influencers to back, endorse, promote projects that they believe in, while also offering a negative incentive if they're backing projects that aren't good. And then on the flip side, you're offering positive incentives to people to back a project, even if it's like very low funded. And so pretty much the problem with crowdfunding is it's very difficult to get past 30% funded. It's like that 0 to 30%, no one really wants to be the first one. Well, in this scenario, if you're backing in that 0 to 30%, you're going to get a pretty good APY, even if the project doesn't succeed. So, that's the high and low.
I'm curious, like, what was the inspiration from that? Like, did you get it? Was like there another project doing it on chain, or was it something from off chain? And you're like, oh, let's go put it on chain for the crowdfunding like that. So that sounds really interesting.
Yeah, no. So it's actually came from research papers. So we did a lot of like reading up on like academic research surrounding crowdfunding. And so yeah, there's this principle of like dominant assurance contracts, but no one's really played around with it in crypto yet. So we're pretty excited to see how it pans out.
And will you guys also have quadratic funding, like Gitcoin, or will you have like other things and whatnot?
Yes. I'd have to check with Eng to see at what point that will be coming out, but I know that's very much like on the horizon.
And another question. So how would you respond to people that say like, oh, like discourse is fine, we don't want to move over, oh, Snapshot's like good enough? Like, how would you respond to those like questions.
Yeah. So I mean, taking a snapshot first. So we have a really great partnership with Snapshot, where we're much more like partners versus like alternatives. Snapshot's fully embedded in our site, fully bidirectional. It just makes it really easy to like vote and view discussions together. But if you want to still do it on Snapshot site, you can. Going more towards discourse, I think especially in the last few months, we've seen, like millions of dollars being hacked and stolen from people via Discord. We can see huge amounts of spam and like malicious accounts in discourse. I'm not sure if you guys have necessarily seen that with yourselves, but you're not able to actually do like token gating. You're not able to see like, okay, like what wallet is associated with this user? Like, are they actually a real community member, or is this like one of 100 accounts that some random VC fund created because they're trying to like push their own initiatives? And so, by offering much more cryptographically transparent discussion forums that are also then immutable, backed up on chain, if AWS goes down, as we saw happen with Discord multiple times, even just this year alone, you're not going to be without your information. And so, really, the on-chain aspect and like crypto native aspect is really where we separate ourselves. And you guys have been lucky, I guess, to not have explicit issues with your platforms, but it's only a matter of time.
And one last question for me. How long does it take to, like, if I'm a project that is transferring from Discourse to Commonwealth, like how long does that take to like go like upload all that information from Discourse to Commonwealth and do like the whole transfer?
Like minutes. So it's very frictionless experience. We just need the export file from you guys, and it'll be set up in literally minutes.
Cool. Does anybody else have any questions? Gonna keep scrolling. No, don't say anything. Well, George, thank you so much. If you can let people know like where they can find Commonwealth and learn more about it and learn more about yourself, feel free.
Yeah, so our website's Commonwealth.im, like instant messenger. You can go check out the Frax space on there. We also have a proposal live on your guys' forum right now that you can check out. Then feel free to scroll through my Twitter or even just DM me if you want to learn more about, I guess, me personally.
So thanks so much, George, and well, I'm sure we'll see you soon.
Yeah, thanks for having me.
Sweet. And last but not least, we have Mr. Publius from Beanstalk. Publius, how you doing today?
Doing great, sir. How are you?
I'm doing pretty well myself. This has been a lot of fun so far for the first space. But yeah, let's get this going. For those who are unfamiliar, can you give a little bit of an introduction to yourself and to Beanstalk and to what you're proposing?
Absolutely. So we are Publius. We're the founders of Beanstalk. At this point, we're just a small part of the Beanstalk community, but we still do a lot of the talking when it comes to public-facing things, and whether that's a good thing or a bad thing, we'll leave that for you to decide. So, what is Beanstalk? Beanstalk is a non-collateralized stablecoin issuer and is fundamentally different from every other current stablecoin, but pretty similar to previous attempts at failed non-collateralized stablecoins like ESD and DSD. Not very similar to Terra for a couple different reasons that we may or may not get into if people have questions. But the concept is Beanstalk is a credit-based stablecoin issuer. And the credit is what we'll end up talking about and how it can potentially relate to Frax. But just to give a little bit of context on Beanstalk, the protocol was deployed on ETH mainnet in August of 2021, so a little over 10 months ago. And we didn't have any sort of venture backing or a pre-mine or pre-sale. So the first 100 beans, the 100 stable coins, pegged to $1 were issued when we deployed the protocol, and a lot of volatility in the Bean price. It traded as high as $4 and as low as 24 cents. But unlike all previous other attempts at non-collateralized stablecoins, which ultimately collapsed due to economic issues, Beanstalk uniquely collapsed because of a governance issue. So in April of 2022, a little over, just under 2 months ago now, Beanstalk's on-chain governance was exploited, and 100% of the protocol's assets were drained from it, rendering the stablecoin currently worthless. So the context and what we're still doing here, though, in talking about Beanstalk, is that despite the governance attack, there is a lot of interest in the potential of the economic model, and the hope is to basically turn the protocol back on upon completion of 2 very high-quality audits from Trail of Bits and Halborn that are being conducted at the moment, and to continue to allow the economic model to demonstrate efficacy or lack thereof. So can go into as much as people want, and it seems like a lot of the audience is Bean people as is, so perhaps we'll refrain from going deep into the model unless people have specific questions. But to talk a little bit about the proposal that Beanstalk Farms made. Beanstalk Farms is the decentralized set of contributors to Beanstalk that are all working on various parts of the protocol. There was a proposal made for Frax to participate in the barn raise, which is the recapitalization of Beanstalk that's happening at the moment and will run until the protocol is turned back on or replanted, if you will, upon completion of the audits. So in short, thinking out loud here a little bit, what is Beanstalk's, what does it mean to be a credit-based stablecoin, and how can it relate to Frax before we even talk about the specifics of the proposal? So from a macro perspective, the collapse of Terra made it very clear that endogenous collateral of basically any type is highly correlated with demand for stablecoins, and therefore it's not great collateral. So one of the things that really piqued our interest was the response from the Frax community to the collapse of Terra to move towards an updated version of the model. And frankly, I'm not super in the weeds on the latest discussion, but as we understood it, the concept was to, instead of having FXS effectively just be equity in the protocol, to ultimately try to back it with other exogenous assets that can serve as some sort of collateral. And the concept is, in practice, what that tends to model, and then what you're really focused on, is how to line up your liquidity requirements with your liabilities. And where you can make money as a protocol is by lending out money and potentially taking a spread or a positive carry on the loans, as long as you're able to match your liabilities with your liquidity requirements. And the concept is you have FXS liquidity, which can be really bolstered if there's a high quality and diverse set of assets that are backing the FXS, as we understand it. And so what was very interesting within the Beanstalk community, and how there could potentially be a symbiotic relationship between Frax and Beanstalk, is Frax is looking for places to lend money to effectively, and is looking for, and this is the part where there is a little bit of friction, and we'd have to work through, I think the two communities would have to think through how this would all work. Whereas Frax, and in a traditional banking model, you have loans with fixed maturities, and therefore it's a little bit easier to match up your assets and your liabilities in the case, and particularly over a time horizon. Whereas in the case of Beanstalk, one of the unique features of Beanstalk is that the debt and all of the assets are effectively not dated. There's no maturity on the yield, and the yield is instead, the rate of the yield is determined, but when the yield will be received is non-determined. And so from some perspective, that makes, if FXS represents some holding of Beanstalk's debt, it's interesting because it has a fixed value in the future, but there's no fixed liquidity date over which FXS would then be able to liquidate the position. Now, you do have some sort of secondary market in most cases in Beanstalk, but I think the point still stands. The question that needs to be answered is whether Frax as a community is comfortable lending assets to a protocol like Beanstalk that doesn't have a fixed maturity, that instead has a fixed yield. And think that it would probably most make sense as a piece of diversification within the larger book, if you will, that consists of some shorter dated assets, some longer dated assets, and then in the case of Beanstalk, some undated assets, which is sort of novel. So that's speaking at a more macro level. At a micro level, there's really two different lending opportunities to lend to Beanstalk from a theoretical perspective. Normally there's only one, but as a result of the attack, there's a one-time, or limited time, I should say, to be accurate, a limited time opportunity to lend under slightly different terms. So normally debt in Beanstalk, debt is called pods. Pods are paid on a first in, first out basis based on new bean mints. And when you lend to Beanstalk, you can't reverse the loan, as we were saying, and there's no maturity date. Instead, your loan is converted into pods, which you then own and can trade on the pod marketplace. But the concept is the pods at some point can be redeemed for beans and then sold back into Frax or another currency of your choosing at some point in the future when the bean price is above 1, because beans are only minted when the price is above 1. And so the question is, well, how long will it take for your debt to get to the front of the line? And over time, what we saw was there was a secondary market where there was some sort of yield curve forming, where stuff in the front of the pod line was valued much closer to the value of a bean, whereas stuff in the back of the pod line was valued much closer to the current going interest rate. But in reality, there was even an opportunity to make a market there of lending to the protocol directly and then selling it on the secondary market, because there was limited opportunities to lend to the protocol. So the concept is that's the normal way to lend to the protocol, and that will be something that perhaps Frax could do in perpetuity, assuming both protocols are working well. Over the short term, there's this barn raise, which was what I believe the Beanstalk Farm specific proposal was about, which is that there's a one-time opportunity to lend to Beanstalk at a 500% interest rate. So for every dollar that is lent to Beanstalk, you'd at some point receive back 6 beans, and again, that would be only received at the time where the bean price is above $1, and so then they're worth at least 1 USDC or 1 Frax. So the concept is, unlike pods, which are first in, first out, this new token from the barn race, which is called fertilizer, is semi-fungible, and all fertilizer token holders will receive a pro rata portion of bean mints every time the bean supply increases, as opposed to in pods, you have to wait for your turn in line. If you own fertilizer, you'll receive a portion of bean mints every time the bean supply increases. So at least I think, and I wasn't directly involved in the proposal, but I think one of the thoughts behind the barn race perhaps being more attractive as a starting place for Frax to lend to Beanstalk, as opposed to the pods, which are less liquid in the grand scheme of things, or have a less short, a longer term expected maturity, let's call it. The concept is that with fertilizer, Frax could realistically expect to start getting paid back their first loan to Beanstalk immediately whenever Beanstalk is replanted or shortly thereafter. And so the thought is it's potentially a slightly less risky play up front for Frax as a first kind of wading into the waters of interacting with Beanstalk, which is another decentralized protocol. So that's the high level thought on the proposal and how it would work. I know I went a couple different directions here, so happy to answer any and all questions, but very, very appreciative for you guys for having us.
Of course, yeah. One question off the bat I have is, how did you guys come up with the number 500% for like the specific barn raise rate?
Well, it's a great question. So originally, there was a couple different iterations of the barn raise. The first one had an interest rate that increased over time, and people had to get in line. It was another non-fungible debt line on a first in, first out basis. There was just going to be a new line. And basically, in short, it was very complicated to explain that to new participants in the ecosystem. And given that the vast majority of Beanstalk people had, gotten burned, there was only a limited expectation for how much the community could reseed the protocol. So the concept was to make it somewhat easier for participation across the board, to make it effectively a fungible round of participation. And the question was, well, how to settle on an interest rate? And the top interest rate that was going to be offered in the non-fungible version, I think, was 470% or 472% or something. And so to make it simple, it was rounded up, and the fungible 500% was introduced.
Okay. I guess another question is like, I mean, for like individuals and degens, like 500% is normal in the space, but like, how would you respond to like those who are like more conservative, like those token holders who are like, wait, 500%, like what's going on here? Like, what would your response be to that, to those who are conservative?
Well, there's a couple things to be said. One is, it's very hard to evaluate Beanstalk as a conservative play at this point in time, particularly coming off such a vicious attack. So that's one of the things. It's, conservative would probably not an accurate description of things here. Separately, it is worth noting that the protocol had an interest rate of something like 50x prior to the attack on the first in, first out debt line. And that will be the interest rate upon restart. If you're getting to the back of the current debt line, which is something like 620 million pods or something long. So the concept is, it's a significantly lower rate than the protocol was offering prior to the attack and will continue to offer if you're getting in the back of the line. But as we were saying, you're actually sort of skipping the line because there's this fungible token that will receive a portion of Bean mints immediately after restart until it's paid back. So there's some aspect of skipping the whole line. So you shouldn't get the same rate as the people at the back of the line. So it may seem like to answer you substantively, DeFi Dave, as to how it's possible that it's such a high interest rate, there's a lot of expected growth in the bean supply baked into any sort of loan to Beanstalk. And the concept is, Beanstalk had grown from 100 bean supply to 100 million bean supply in about 8.5 months between when it was deployed and when it was attacked. And over that time started to pay back a significant amount of loans to Beanstalk. So you can do the math based on the position that you have in the pod line or the amount of fertilizer that you have at exactly what bean supply you'll get fully paid back at. And then it's a question of, well, how do you discount the likelihood and the time that it will take to Beanstalk to get to that bean supply? And in short, if you're looking at, it's up to everyone to decide on how to evaluate that. But if you're just doing some macro level analysis, the current state of DeFi, we've got this short-term drawdown, which is pretty painful for most. But the concept is the value, if you're at the very back of the pod line and lending to Beanstalk at call it a 50x, you're effectively valuing Beanstalk, or you'll get paid back roughly at a 2 billion bean supply. I'm happy to walk you through the math if that's helpful. But I'm sure in the Discord, people can be much more detailed if people want to come hang out in the Bean Discord. But the concept is, people are effectively valuing Beanstalk at around 2 billion. So and that's for the 50x. So if the bean supply grew from 100 million to 2 billion, so there's a 20x in the bean supply, lenders would effectively book a 50x. So that's where the incentive to lend to the protocol, or the alpha for lending to the protocol, depending on how you want to think about it. Maybe it's not alpha, but the best risk-adjusted return for lending to the protocol probably comes from lending to the protocol, and that's by design. Beanstalk requires lenders to create stability. But the concept is there's this new tranche at 500% that effectively gets to cut the line. That is value. It's unclear exactly what you're valuing Beanstalk at, because it's somewhat dependent on how much participation there is in this round. Currently, there's been about $9 million in participation already into the contract. There's likely going to be
That was
more
actually my
participation.
next question. So it's 9 million. So okay.
9 million has been in the first week. The barn raise actually started a week ago today, and it's going to run for presumably another month at least, until Beanstalk is replanted sometime, hopefully around a month or so from now. And we're just waiting for the audits to be completed and to get the go ahead. So the concept is there's this new token, which, let's say Frax lent 5 million. Let's just do some napkin math, right? Let's say Frax lent 5 million Frax to Beanstalk, and for a 500% return. So Frax over time is expected to get paid back 30 million beans. If Frax accounted for, let's say there's another $10 million of participation, so Frax is 5 of the 25 million that lent to Beanstalk at the 500% weather, there is the opportunity to continue to buy fertilizer from the protocol, but at a lower and decreasing, I think it's called humidity. That's the interest rate on the fertilizer once it restarts. So there's some question of dilution on the valuation here. So it's not perfect, but let's say there's no future dilution. The math is basically, if you're buying a fifth of the future bean mints that are going to fertilizer, and you're getting paid back 30 million in total, that means that 150 million beans have to get paid back to fertilizer, and fertilizer is getting a third of bean mints. So 150 times 3 is 450 million. So roughly, you're probably valuing the protocol at around 500 million to get fully paid back, which is a significant discount to the 2 billion valuation, let's call it. But and valuation isn't probably the best metric. It's more demand for beans. What will the supply of the stablecoin be? And I think you guys are very familiar with the contraction, at least in the short term, in demand for stables, but betting that will turn around at some point in the not too distant future for a couple different reasons. I'm happy to talk about that as well. But that's the napkin math. So assuming no further dilution, you're probably fully paid back at a 500 million supply.
Nice. I'm going to leave it to the floor if anybody has any questions. Take a scroll up and down. Don't say anything. Well, Publius,
is there a floor? Is there is this happening in like a gather town or something?
Yeah, this is the town square. I mean, Twitter's the town square. It's our virtual town square, and we're all like gathered around in the corner speaking, metaphorically speaking. But Publius, like I'm a huge fan of all types of stablecoin experiments. I think it's super healthy, and of course there's going to be hiccups, and we all run through them, and I hope that you guys come up from this and make it through this. Like, it seems like you're powering through, like the worst is over. It's just a matter of like, completing the raise and replanting the seed and let the harvest sprout in the future. So best of luck to you.
Appreciate that very much. It's like Beanstalk. One of the difficult things is, so Beanstalk has never really needed any money, if that makes sense. And for the first time, it kind of felt like, well, there was all this money taken, and now Beanstalk needs money again, or needs money like for the first time, let's call it. And I guess you could make the argument there have been periods of time where the bean price was below $1 and Beanstalk was trying to borrow more money, but this was a little bit more staring you in the face, right? And so it's actually been amazing to have the DAO respond and approve plans moving forward to basically have the protocol scale down in the short term, such that it can healthily restart, or hopefully healthily restart it with any amount of capital. So very excited that the 9 million is already in. Think that, over the next month, there's probably going to be some more capital that comes in. And more generally, we're very excited with the prospect of partnering with, and I don't really like the word partnerships, particularly when it comes to protocols, but I think at the DAO levels, having some sort of interoperation getting started here, I think it could be very complementary for both Frax and Beanstalk, because Beanstalk needs a bid for debt, and Frax needs yield on loans, and that is a really harmonious potential relationship between the two protocols. So appreciate you inviting us and hosting us today, and hopefully this was somewhat informative on how that relationship could potentially be formed.
Maybe somewhat. One last question. Can you give, where people can learn about Beanstalk, where they can find Beanstalk and learn more about yourself?
So the website is Bean.money. There's a link to the Discord and the white paper. Those are probably the two best resources. The Discord community is we think it's amazing, the discourse happening there. So if people have questions or comments or whatever, please come there and hang out. And would recommend the white paper for people that are more technical or interested in a deeper understanding of the protocol and how it works. Don't really, we're on Twitter if people really want to follow us, but Beanstalk Farms is doing most of the work, and so you should give Beanstalk Farms a follow on Twitter. And otherwise, builders are welcome. There's lots of stuff to be built with Beanstalk. So appreciate everyone.
Of course. Well, thank you to all our guests for coming on to discussing their proposals. I've definitely learned a lot today. And I hope the Frax community and beyond has gotten something out of this. We're definitely going to be doing more of these things. I was already thinking, looking at all the proposals in the farm, oh my God, we missed so many. So, so there's definitely going to be more in the future. It's really, promising and really inspiring to see all the proposals that are in the Frax forum right now. And we're going to just keep the momentum rolling here. No matter the market conditions, we're still going to be here. We're still going to be building. And, I'm super excited for the future. Thanks for everyone for coming on.
Oh, and don't forget about our proposal that we have.
Oh yeah, one last plug. I don't want to be too shameless with the plug, but we do have a proposal for Flywheel for a podcast and media grant. It's $18K of Frax and FXS over a 3-month period to basically just fund our efforts and just growing awareness for the Frax ecosystem. We're going to do interviews with Flywheel. We're going to keep doing these governance spaces where we want to do a weekly newscast similar to our friends at Curve Market Cap. See you guys in the crowd. I love your guys' work and everything that you do, and we definitely take inspiration from that. I think there's just overall definitely room for these sniper shot media organizations for these future juggernauts, whether they be Frax or Curve or whoever else. So I'm just honestly, like I said earlier, even though the market outlook is bleak, long term, I couldn't be more bullish in what we're all building here. And just seeing the amount of support and the amount of people and organizations that want to work with Frax, it's pretty awesome. And yeah, so with our proposal, it's live on Snapshot right now. Please come and support. Please vote yes. We won't let you down, Frax community. We won't let you down, Fraximalists. We'll make you all proud. And I'm excited to see where Flywheel grows from here. And we're going to keep spinning. We're going to keep rolling no matter the conditions. So, yeah, vote yes on that. And thanks for everyone for coming on. Thanks for everyone for listening. Awesome to see everyone and all the support here. And we'll catch you all at the next one. Ciao, ciao.